All right, well, I'll run through the quick overview of what today's webinar is going to be, but I'll firstly introduce you to your panelists today. My name's James Gerrish. I'm a portfolio manager at Market Matters. I'm also a senior portfolio manager at Shaw & Partners, here to run the webinar today on resource stocks, and I'm thrilled to be joined by a senior analyst at Shaw & Partners who's getting a call on his watch at the moment. Peter O'Connor. So for many of the Market Matters subscribers out there, you'll be very familiar with Rocky, as he's affectionately called, who's joining us today to talk all things resources. We're going to talk coal, gold, copper, iron ore, lithium, all of the key things that everyone is very much interested in at the moment, given what's playing out in the market. So Peter O'Connor, Rocky, thanks very much for joining us.
Thank you, James. Pleasure to be back again.
As I said, we're going to touch on a couple of key things. So coal stocks have been they've been hot, then they've been not, and now they're rallying again. Gold stocks have been, as you like to put it, in the naughty corner for a very long time. They've had a few false dawns, but is this now the ultimate change of trend towards gold? There's been a bit of corporate activity playing out in the resources space, the biggest one being BHP's tilt for Oz Minerals. And where should we look next in the copper space? Fortescue, it's been volatile. It's rallied in the last couple of weeks about 30%. They've got a new CEO in their iron ore division. We're going to touch that, and then lithium stocks have been hot and where they can go from here. So thanks to everyone on the line today. Thank you very much for joining us and giving us your time to understand a little bit more about the resource trade at the moment. In terms of the disclaimer on the screen there, I just wanted to stress that any advice provided today is of a general nature only, and you should consult a financial professional before taking any of the information on board. So general information only today. Just a quick overview of the Market Matters investment team. I'm the lead portfolio manager. I've got a bunch of other key investment personnel, and of course we're supported by a number of analysts through our relationship with Shaw & Partners and others. I'll just get my email off the screen there. In terms of where to get underway today, so I've been logged out of Bloomberg, which is not ideal. I'm just going to stop sharing the screen. I'm going to log back into Bloomberg. So I just want to give you a quick overview of what we're going to look at today. So Rocky, I'm going to kick off with you. So while I get this underway, I want to talk coal stocks. So coal's obviously been, very, very volatile in the last little while. We've had 18 months of really strong uptrend in coal. We've had a 30% pullback in prices. Some of the coal producers have pulled back. What's your take at the moment?
James, I'm going to give you a long answer, but I'm going to give you the short answer first. So the conclusion is coal equities will continue to travel higher over the next several months. And the next sort of checkpoint will be as we come out of northern winter into northern spring. And that'll be as the energy demand profile changes into the new year, and a few other backdrop items. But that's the context where the coal equities can continue their move. So coal equities have been the best performing in the mining sector this year. Whitehaven year to date is up about 260%. Do we expect that to be the same in 2023? No, but we do expect they can continue to perform, particularly in the first quarter of next year as this carryover trade continues. So that's the short answer. Long answer is, caveat firstly, I support energy transition and the need for the long-term decline of fossil fuels. But I'm also very pragmatic. I acknowledge that fossil fuels need to be here for that transition. So with that in mind, there are several layers in which we need to think about the answer to these questions. Firstly, coal follows cyclical factors, as do all commodities we'll talk about today. Importantly, in the coal space right now, going through into the northern winter into early next year, the factors are as follows. Firstly, it's winter. It gets colder, you burn more fuels to generate energy, to generate heat. So that's the key. Out of Northern Hemisphere, we're starting to get cooler weather out of Europe, and that's important to the demand profile and with restocking of energy units in Europe at the moment. That's number one. Number two, the two marginal energy units into Europe at the moment are gas and coal. They both have retraced, as James mentioned, both back 20 to 25%. They've both rallied back about almost that much. Gas is now back up about 22%, and coal's back nearly 30% from its recent low. So that move in restocking started to show through in price, and we expect that to rally into the end of this year, the new year, as again that demand profile and winter picks up. Lastly, supply. La Nina has been a feature of our weather patterns for 3 years. It's affected supply across the globe, but particularly in coal across Australia and also Indonesia. And that's impacted supply, which is keeping markets tight. And that's separate to the whole Ukraine issue, which is another story. So on the basis of that, what do coal prices do? They stay higher, and they in fact will move higher off their recent lows into the next couple of months. And at the next break point, we'll evaluate this will be at the end of winter into spring next year. So we've got a runway of maybe 4 or 5 months. That's the major issue there. Secondly, longer term cyclical factors in this journey that we're on. Supply is going to be critical to this. And I noticed just in the last week alone, there's been a major Queensland government decision to halt the approvals of a major coal mine in Queensland. 2, the federal government is now sitting on 15 recently projects that have been pushed through the pipeline, questioning whether they should get final approval. 3, Lloyd's of London have decided not to insure any coal mines going forward. And also Nippon Steel, as a major buyer of product globally, have said they will want to increase their self-sufficiency, so they'll be trying to find whatever coal they can to buy. So there's going to be a much tighter supply side. And in terms of demand, whilst demand will decline over the long term, demand will reflect the move towards higher quality or lower emission products, which favours a lot of our Australian products. So pulling that down to the equities, what will they do? Equities will trade higher in the near term on the back of that coal price view. Free cash flows are extraordinary in this sector. So despite the moves I mentioned earlier, about 260% year-to-date performance, free cash flow yield for the sectors is somewhere around about 50%. Dividend yield, and caveat here, never buy resource stock for dividend yields, but enjoy them on the journey that you go on. Yield at the moment is about 16%. And 2 of the major companies have buybacks in place, so compressing the share count, which means it's growing your EPS and growing your share price. So against that context, the outlook looks positive in that, again, short term, medium term, longer term. There are those buybacks in place, contracting stock means there's a marginal buy for these equities. And we also know overseas there's been new buyers coming in for coal stocks. We did struggle a few months ago to work out who would buy coal equities. It's now coming out of North America, out of unlikely places like Dallas, which they understand fossil fuels, out of Europe as well. And we note that industry super funds in Australia have drifted their style, which they said they wouldn't, but they've been buying coal equities as well. So wrapping that all up, coal equities have more room to move in the near term and more room to move in the longer term, albeit the coal price will settle out at a lower level longer term, but much a higher level than previously thought. So coal equities look fine, James.
Okay, so bullish on coal equities. And I guess the takeout that I get from that is that there's going to be a very, very tepid supply response, if anything. Demand is going to stay reasonably high, and that should be supportive of equities. Obviously, the ESG thematic has been well and truly, it's happening. It's just going to take longer than perhaps many expected it would. If you look at I've reverted back to the Market Matters website there, which has obviously charting and a lot of the key features that our subscribers like to follow in terms of current metrics on particular stocks, etc. This is Whitehaven on the screen there. I'm going to get New Hope up in a short while. So Whitehaven, you've got a $15 price target. It's trading today at $9.89. You're the most bullish in the market. There are other, I think consensus price targets about $11. There's a cluster around 13. There's a few on the bearish side, but those bears have capitulated over the last little while. So is that a realistic target, $15?
Absolutely.
Or is that just pie in the sky
James,
sort of stuff?
We go back the journey we've been on webcast we've had together before. We were talking about this name at $1 per share. So we've set stretch targets, but that word should be encapsulated in their realistic targets. And they're always founded in fundamentals, not just putting some sort of ambit line in the sand. So why do we see that? If you look at the correlation in every single stock we'll talk about today, the commodity equities follow the commodity price on 95% of occasions. So it's a really easy job I have, just to pick the commodity price and the equities will follow. Plugging spot numbers into my Whitehaven or New Hope or whatever coal model gets share prices dramatically higher than where they should be. In Whitehaven, it should be closer to $20 per share than 15. We've set a reasonable target of $15 per share where they should trade. Yes, ESG discounts, we'll see that perhaps a little bit more challenging. That's where we then step down and look at the buyback. Whitehaven is committed to buy back over 20% of its stock after doing 10% last year. So over the next 2 fiscal years, fiscal 23 to June in calendar year 23 and into the following year, they'll buy back about $2.5 billion worth of stock. That will compress the shares on issue and grow the share price as well. So those 2 factors, James, will get me to that target price. So I'm comfortable with that. And I think we'll see the race to get there will probably be through this winter period into the first half result and the dividend and the progression of their buyback. So yeah, the background and the tailwinds are favourable and continuing into the new year as well.
I've got new hope on the screen in front of you there, just to share the key metrics around consensus numbers. So revenue was $1 billion, it's going to 3.6 billion. EBITDA was 370 million, going to 2.6 billion. And the numbers are phenomenal. And I'm not one to sort of chase the herd. And we own Whitehaven. We sold it too early. We own it again in our flagship growth portfolio, and we own New Hope Coal in our active income portfolio. So that's Market Matters positioning around coal. I want to move on to another, or not another one, but the most unloved sector in the Australian market, I think, over the last 18 months or so is gold. We haven't made any, I can't remember the last time I've made money out of gold. So tell us that we're going to make some money out of gold in the coming 12 months, and it's going to get better, Rocky.
You can. So gold, absolutely, and I stress absolutely can and will rally into the short, medium, and longer term. Gold equities are without question the cheapest resource equities that I cover in my universe, and I think in the broader resource universe globally as well. They're trading at as a deeper discount as half of their fair value, and that's local and global, large and small names. So the discount is broad-based. The underperformance James mentioned goes back to the US dollar gold price peak in August 2020. And what happens, gold follows the monetary policy cycle. So that's critical to where we go from here. So if I was to point you to one thing, it's following what the central bank of the US does and where rates go. And whilst rates will likely go higher, what we've been watching very closely is the rate at which rates will go higher and how long for. And that what relates to what's happening with inflation and clamping down on inflation. And ultimately what that leads to is real interest rates. And that's the key driver of gold. So we're starting to see that tempering of inflation expectations, tempering of central bank policy, or becoming more dovish than more hawkish. And that's leading to this move in gold. So to be clear, gold, US dollar gold price bottomed in its downtrend from April this year, about a month and a half ago. It's now broken out of that downtrend. The Aussie dollar gold price has also broken out of that downtrend, both supportive to the at least the near-term performance of gold equities. And importantly, longer term, a key correlation feeding from central bank policy is the US dollar. The US dollar is a key proxy for everything we talk about in the resource space, but particularly gold. When and if the US dollar peaks, and we look at a ticker called the DXY, the dollar index, that's trading at an all-time high. As that rolls over, which it peaked about a month ago, that's constructive to the complex as well. So other things just to add to the debate, and they're the bigger picture items, but the other items are crypto. Crypto's been a lot of noise for the last 2 years. The crypto market grew from $800 billion 3 years ago to a maximum of about $3.2 trillion. Gold at the same time was stagnant at about $11 trillion. So gold lost a lot of flow to crypto. I don't need to tell you what's happened to crypto lately. You can read the headlines, but suffice to say that $3.2 billion is back at about 800, and crypto's now just noise in the gold space. ETFs, if anybody looks at it and is trying to get a guide, they're at best a coincidence indicator, so don't look at them as a primary guide. Typically they actually lag. The other point I'd make is long-term. If you follow US monetary supply, and the US has been pumping out a lot of new printed paper for a long time, as money supply grows in the US dollar price grows with that at the same rate. So if you take a view, gold price will grow at the rate of US money supply, which is currently running about 10%. So taking all those big picture thoughts down to gold equities, what happens? In a constructive environment where US dollar gold price is broken out, Aussie dollar gold price is broken out, the Fed's been printing paper and that continues to grow the long-term price outlook. Crypto's fallen over, the dollar index has peaked, gold equities will rally as they have. So gold equities are up 30% from their low. So this is not just, are they about to rally, James? They have rallied. And they were year to date, gold equities, even after that recent move, is still down on average 30%. The worst performer there is a company called Aurelia, down 90%. The best performer out of the bunch is Northern Star, it's up 10%. So we have had some positive names, Golden Road, Northern Star, two standouts. Our picks in this space, and I'll take you through large, mid and small cap. The large cap end, there's Evolution, Newcrest, and Northern Star to pick from. We like all three of those names, but Northern Star's been the outperformer in calendar 22. We think the catch-up in calendar 23 will be Evolution and Newcrest. Why we pick Evolution as our preferred is that it's got some great bottom-up news coming through. And Newcrest has had a few foibles. One, it's had a fatality, its offshore operation, and two, it's had an environmental issue in its local operation. So that little bit of noise may temper Newcrest performance, but Evolution got some great tailwinds going to the new year. They have had what they would term their worst year since they listed. And they're looking to address that in FY23 and deliver much better performance. That's a big cap pick. In the mid cap space, we like where Regis Resources is traded. It's actually up 1% for the year to date, James, which is extraordinary, given the market hasn't liked that one, but it's got confirmed its guidance at its AGM last week, and it's also just very close to getting its final approval for a project it's got in New South Wales, which will catapult it to being a major 500,000 ounce gold producer globally by 2025. So that's going to be important. The small cap end, a colleague of mine covers that. We like Ateco, we like Black Cat out of WA, and we like Matador Resources as well. But I just want to highlight a couple of special situations in gold. If you like M&A and you like the flavour of what could be offshore interest for Australian gold, De Grey is the standout, large reserve, large resource, meaningful asset, which somebody like a Barrick or a Newmont offshore would look to buy, and there have been rumours and scuttlebutt and talk in the market about that. And elsewhere, there's a thematic about consolidation in gold, very bottom-up driven, not just top-down, but there are two areas in WA. One's around a town called Leonora. The other's in an area called the Gascoyne. And in Leonora, there will be like a Pac-Man, a company called Genesis, ticker is GMD. They will be the ultimate winner in the Leonora space over the next 1 or 2 years. On that journey, they will pick up the likes of St Barbara, ticker SBM, Red 5, ticker RED, Kin Mining, ticker KIN, and consolidate to be what could be a 500,000 to an 800,000 ounce producer located around that province, with resource base of over 20 million ounces and productive capacity to get to that level. So that's one to watch, but the way to buy that is not buying the acquirer, is to buy the targets. Those targets are SBM, RED and KIN. And the Gascoyne area, it's likely we'll see consolidation amongst Ramelius, RMS, Western Gold, WGX and Gascoyne. Gascoyne's currently in administration at this time. So there's a lot of ideas to play there, large, medium and small, special situations as well. And importantly, gold equities perform well and they've got a tailwind, and they've now got a tailwind going into the new year, and that is likely to take the sector higher.
Okay,
so that valuation gap.
So to package all that up together, and there's a lot there, we're bullish gold. We think inflation's ultimately peaked. Interest rates or bond yields may well have peaked, and US dollar is therefore peaked. The US dollar index is trading around 106. We write about it regularly in our Market Matters reports, and subscribers will be well across that. We think that US dollar is ultimately peaked and is maybe due for some consolidation. It's been a reasonably short, sharp correction on the downside. We tie it in, we often look at the Bank of America, Merrill Lynch investor surveys and look for how the market's position against particular themes. And one of the things we highlighted was the very strong bullish positioning, the consensus long trade on the US dollar. And that was a major headwind for gold and gold equities. That now has started to reverse, and that's going to be bullish for gold. In terms of Market Matters positioning, we own Newcrest in our large cap, our flagship growth portfolio. We've kept it simple, stupid. We own St Barbara in our emerging companies portfolio. And we're looking to add another gold stock in both of those portfolios to take advantage of this, likely upside in terms of the gold price and gold equity. So a lot happening in terms of the gold space. I want to focus now, turn a little bit more towards copper, but also BHP, because BHP's launched a big takeover bid for Oz Minerals. Maybe more to play out. Maybe it's a done deal. It looks like a done deal. This has been something that's been, I can remember back in Oxiana, and then it became Oz Minerals and the like, where this was always going to be a takeover target. They've chosen a pretty interesting time to acquire it. I mean, they're paying $28.50 odd to acquire Oz Minerals. Oz Minerals is trading $3-4. Mm-hmm. Why now? And why is it? What does this say about BHP moving forward?
So I raised the same question, James. So I've liked Oz Minerals since $3, and I write that all the time. So I've liked it since $3. I love what they've done. The new management team, which started in 2015 at that price, what they've delivered and how they've set the company up. So they're ultimately going to deliver a $28.25 price to their shareholders. It's been a fantastic return. Why did nobody look before this? I'm just astounded. So, and I put that to BHP. Why are you looking now? So the new CEO of BHP has been in his role for 2 years, said, Peter, I have to look forward, not backwards. Yes, if I had the opportunity, I would have liked to have looked earlier. I'm new in the job. I had to, they had the unification of BHP this year. They've had the spin-off of the petroleum group to Woodside. They've had a lot on their plate. Oz Minerals may or may not have been there in the background, but it's certainly, they've taken the opportunity when they've had some clear air to do Oz Minerals. But what it tells us about the larger cap end of the market is both BHP and Rio need growth. They're both heavy in iron ore, heavy in steel-related commodities, and they're both articulated visions about being better placed in what they call the future-facing commodities: copper, nickel, potentially lithium, etc. So that's where they're both steering. They've both actually got bids in copper at the moment. So we always talk about BHP and Oz because it's current and we know Oz locally. But Rio Tinto's had a bid underway for multiple months for a Mongolian asset with a Canadian listing called Turquoise Hill. That bid is getting close to being completed as well. So both the companies are trying to mop up copper equities because they like the outlook for the copper market. And so it's worth noting that BHP are late-ish to the table in the short term. And a long-term view, they're probably still early. But would have loved them to have done this at sub $20 per share. But they're getting a company which will likely trade in the future if Oz Minerals is still public at well more than $30 per share. So it is fair value to cheap-ish in the context. It's not a super cheap acquisition, but it's certainly a sensible, smart, strategic, logical deal.
I was going to ask you about that. So you look at some of the comparable transactions that are playing out, that would have implied a higher multiple, a higher price for Oz Minerals. So you look at what they could have bought it for, but they're not overpaying for it, are they?
It's like real estate, James, when you've got your houses in your street and you see a house sell down the road.
They're all going down though, Rocky.
Well, at the moment they are, but that's the thing, you get a print on value and you know straight away what the value of your street is. And the same with copper. Copper M&A tells you what's happening out there. So the Turquoise Hill bid I just mentioned by Rio Tinto, the ticker there is TRQ-TSX, it's Canadian listing. So that implies a sort of a flow-through value of Oz Minerals, which is closer to $40 per share. I wrote about that recently. BHP got quite incensed about it. But how could I be saying it's worth that much money? But that's just a see-through valuation like a house auction in your street. So it's worth highlighting that Oz can see higher value, but what this particular deal lacks is contestability. If you remember an auction in your street, if you've got one bidder, it's pretty hard to get them to pay a full price. Two bidders, you get an auction. Three bidders, you get a contested auction. So in the case with Oz Minerals at the moment, it's only BHP. So they've leveraged up the best price they can get with one bidder. So there are three breaks here in this deal. One is that BHP do due diligence, which is underway now, and they go, you know what? This is not as good as we thought. We don't think that's the case. But
surely they know about it.
They know about it. So 19th of December, we'll get an announcement saying, yep, we like it, we're going ahead. There could be an interloper, a third party hovering in the background, waiting for BHP to have that look and then say, well, they like it, we like it as well. So that could see a counter bid. And lastly, the shareholder vote will be probably April, May next year. Shareholders have a chance to decide whether they think this is a good price or not. But in the context of where these larger companies are going, they're all identifying future-facing commodities as where they'd like to be.
And also, is it a read-through about the type of things they're willing to buy? So instead of, obviously we've heard about the complexities of doing, developing yourself, going out there and buying already developed, proven assets. And also how difficult it's been to get high quality staff and guys to execute on that plan. So they're buying a great management team, a great asset that fits very nicely in their own suite of assets, and they've sort of de-risked it.
I think you make a really good point. So, and I should have made this myself earlier, both companies, BHP and Rio, are buying earnings now. They need growth now. They can't wait for 3, 5, 7 years to deliver. So BHP's got a great pipeline. Rio Tinto's got a great pipeline, and they'll deliver compound growth of about 2 or 3%, which is typically what they do. But they've both got a shortfall right now, and that's a shortfall out to 225 pretty much for both. And with a heavy iron ore exposure, they've got that weight of iron ore expectation, they've got that pipeline sort of 3 or 4 years out, they've got this space where they need to fill, so they need to buy earnings today. So you're right, it's cheaper today to buy than it is to build, not least because of the time frame, and also inflation pressures and people. So in that respect, paying a slight premium to get it now is what they're doing. So it is sensible, it's smart, and I can understand where they're going. I just wish they had done it 2 years before.
But you can see what commodities they're bullish on.
Yep.
I mean, you're talking about the reliance on iron ore and the composition of the weight of their earnings that are still linked to iron ore. Yep. I mean, iron ore, the supply outlook for iron ore looks a lot different to the supply in the copper space and other future-facing metals that are a little bit light on over that forward period that we're looking on and are going to be the future. I mean, that's the key. So Oz Minerals, so obviously you made mention of a shareholder vote potentially not till April.
Yep.
So that means it's a long way to play out.
Yep.
So we owned Oz Minerals. We trimmed half of it into the first bid actually, and we trimmed the second half of it into the second bid, or sold the second into the second bid. It's going to take a while to play out. I mean, it's a 3% around about a
Yeah, so look,
3%.
for me, Oz is a dead duck, so it's gone. For all intents and purposes, Oz is no longer trading. So
Okay, so
you
where do
need
we
to
look?
look elsewhere, because if you want to get it, if you want to sit there for 3% return, fine. But if you want to get a return better than that, you need to look elsewhere. So it's funny, copper's this target by everybody globally. Everybody wants to be in copper, but there's so few copper equities to play. And this is not just now, this has always been the case in Australia and globally. So in Australia, the key international, large-scale, long-life target is Sandfire, which is
That's funny you're saying long life for Sandfire. It never used to be the case.
It is, and that's I make that point because it's now international. It's now got multi-jurisdiction assets and it's longer life. So we literally followed Sandfire very closely for the last 10 years, and it's mine in WA. It's literally ended last month. So that life came to an end. But they strategically 2 years ago started to look at reinvesting and growing the pipeline. They've now got an asset in Botswana, in Southern Africa, and an asset in Spain, which is world-class, long life, and importantly, very long life compared to what the market thinks. And like a lot of resource projects, you only drill what you need. And the equity market's only pricing what they've drilled. But this is a very prospective area in the Iberian copper belt in Spain. They will add more, as they already have, and that's going to have a much longer tail. So as an international large target, Oz Minerals,
Sandfire.
Oz is already, but Sandfire. And then drilling down locally, there's going to be consolidation across the deck. We've got a lot of smaller emerging copper companies. So the likes of 29 Metals is more going to be a local play. And then looking at, there's a Cobar play at the moment with two companies. One I mentioned earlier in the gold space, Aurelia. It's really a base and precious metal company struggling at the moment. And Eris, a company, ticker is AIS. They've been bulking up their business in base metals lately. They're likely to potentially look at a consolidation there. And around the Mount Isa area, there are a handful of companies there looking as well. But at the larger, meaningful end, it's really, we're down to Sandfire. Sandfire is trading half of its fair value. It's just announced a new chief executive. It won't start till next March, which is a long way away. But the market likes that new CEO and what he can deliver. And they've going to meet their guidance issue, which they confirmed a week or so ago. And power costs, which has been one of their impediments, are coming down in Europe. So they're better placed. So I like the look of Sandfire on that valuation perspective, the outlook as well.
And they've tidied up their balance sheet as well.
Yeah, and they just did a recent equity raise, which has given them a cushion that they didn't absolutely need. It's more a want than a need, and it's giving more flexibility into next year.
All right, so copper, the outlook over the next couple of years is a bullish one. BHP is telling you that by buying and paying up for Oz Minerals.
Yes.
Why is there, just going back to that, why was there no contestability in terms of other prices? And I know you made mention of, if it was contestable, it could have gone up to $40. But are Oz Minerals selling it too cheap because there's no contestability, or does it just fit with BHP's geography and where they're positioned at the moment?
Okay, I'll answer that, but I want you to remember to ask me another question about copper in the short term. So we need to go back to that. So copper, Oz Minerals is located in South Australia. And dial back to about 2008 when the Oz Minerals were distressed and they were looking for a buyer, and a company called China Minmetals came in and bought them. Remember at the time, there was an FIRB approval issue. Why? Because Oz Minerals sits pretty much within the Woomera firing range.
Yep.
So a Chinese entity was precluded from buying the assets of Oz. So they carved off all the non-South Australian assets into a vehicle which China Minmetals now owns, and Oz was spun off separately. So that's the history, and that's the impediment at the moment. International players will always face that risk of, what if we bid and we go through the process and the FIRB says no? So that's taken it away, but also this is BHP's backyard. BHP bought the Olympic Dam copper asset via Western Mining in 2005. They've really struggled to get that asset up and running. This is in their backyard, and I think what they're buying is expertise. They're getting the best management team in the copper market globally, in my opinion, and use them to get the synergies, the benefits, the putting together 3 assets in South Australia, which nobody else has that same synergy, and operating their own asset better, which their current asset has got a $6 billion US, or effectively the same value as Oz Minerals, and they get zero return from it. Oz Minerals gets a positive return. So by leveraging Oz Minerals' skills into their own asset and get their own asset running better, that's a bit of cross-subsidization as well. So what it's telling me is other buyers didn't have the obvious synergies.
Okay.
There was the FIRB issue as well.
Copper price, you touched on that. It's been trading $3, $4 a pound. It's trading at $3.62 at the moment.
Yeah,
middle of the range.
this is really relevant to everything we're discussing at the coal. I talked about that window between the northern winter into the spring next year where we've got an opportunity. And we'll talk about lithium. We need to be cognizant of, we can have very positive views longer term. Coal may be declining in the longer term, but copper and lithium are going up, but there can be cycles within that. Copper cycle in calendar 23, there is more supply coming to the copper market than we have for many, many years, probably a decade. So copper market is very likely to be actually balanced disadvantageously into FY23, which means copper price may be softer into 23. BHP acknowledged that on Friday at a conference. And if you look at the key consultants who talk about the copper supply and demand, if we have slower economic growth on the back of central bank tightening, and we have more supply coming to the market next year than we've had for an extended period, the market will be at best balanced and potentially a little bit of oversupply. So we're starting to see that coming through in concentrate pricing sales. So be aware, that's a cycle in part of that longer term journey, but it may be the opportunity to buy copper equities next year into that view. Now, BHP's got to take a multi-year view. They can't afford to try and pick day-to-day turning points. But I just thought I'd make that harder because it's relevant when we come to lithium as well. We'll touch on that as well.
Yeah, absolutely. You make a really good point around not getting caught up in the so obviously commodities are quite volatile. There's a lot of push and pull factors that play out into commodity stock prices. We've got a more active approach in our management of our commodity resource stocks in the Market Matters portfolios, and we think that's the right way to go. Copper is obviously a very interesting one in terms of everyone talking about these long-term drivers. And I read so many articles out there that you've just got to own something. You've just got to own these future-facing commodities. Lithium is one of the areas that we'll get onto just after I'll touch on iron ore. We've trimmed some of our lithium exposure recently. It's had a phenomenal run-up. You made mention of coal before, and when we were doing a video when Whitehaven was trading at $1.50, no one wanted to hear about coal. It was one of those trades that people thought were mad writing about or owning. I think that's the same is true with the future-facing commodities on the opposite side at the moment. Everyone thinks you have to own lithium.
I make some observations. So never fall in love with an equity or a commodity, and never dislike an equity or a commodity. Always try and be objective about how you look at them, and try and not go with that conventional flow of the cliche. At the moment, I see, and to your point about coal, everybody hated coal, but you needed to work through the story and be quite bottom up about what was happening to try and understand what could happen. And like I said, most recently in iron ore was trading 1 month ago at $80 per tonne. It's trading over $100 today. If I went through and grabbed all the headlines from that week when it was at its low, everybody was bearish iron ore. Every press story coming out, every journal coming out, every broker coming out was saying, that's it, China, it's all over, iron ore, let's go back to $50. You need to, those moments, not go with that conventional flow. Step back, have a look. And I think that's important for coal. A little while ago, it's coal right now as well. People are starting to go, coal's not going to go any higher, what's happening? Iron ore, it's been the trade of late, and lithium, it's definitely going to happen there as well. So
it's the old saying of what's the remedy for high prices? Well, it's high prices themselves, and low prices are the same. Obviously, less production comes on stream because there's less production being incentivized to jump on board.
And to point about the copper, like copper price looks fantastic. Copper demand looks fantastic on a 5-year, 10-year, 20-year view. Copper price may actually be the copper market may be a little bit unbalanced next year. It's just part of the cycle of life.
So that obviously, the edgier end of the spectrum. So you obviously, when you're thinking about commodity equities, resource equities, you obviously got the large caps that are producing now, they're earning money now. You've got the mid caps, which have got more development, a bit edgier. They've got bigger production profiles in the outer years, but they're still earning money now. Then you've got the explorers. I mean, it goes, if you have a weakness in the underlying commodity, you get most weakness in the explorers, you get moderate weakness in the mid caps, and you still get weakness in the large, but perhaps not as much. So
it's called leverage. So you want to buy maximum leverage when things are going up, and you want to sell maximum leverage when things are going down. So if gold's rallying, you start drilling down the curve and start going, where's the leverage operationally, financially, and exploration-wise and growth-wise? That's why you'll start drifting down the curve.
You just highlighted Fortescue. So it's an interesting one. There's a chart of Fortescue. I'll bring it up to be a weekly chart on the screen there. In terms of what we're seeing in the bigger picture thematic of Fortescue. So obviously peaked out about 26.50. It's had a recent low sub 14. We're now trading around 19.50 at the moment. I remember I wrote about it in the Market Matters income report saying we've got keen on Fortescue. We didn't buy it, it was around $15. It's now ripped in a heartbeat, up 30%, up to just shy of $20. What's your, my view is iron ore is a trading commodity. You alluded to the fact that you've got to be nimble in your commodity allocations. The outlook for new production coming on stream versus demand coming out of the rest of the world. How does that balance over the coming years?
Well, to your question about is it a trade or investment? It's a trade.
Okay.
The iron ore companies are all a trade. Albeit at the current price, they're making an extraordinary amount of cash still. Not quite as much as they were making over the prior financial year, but still an enormous amount of cash, but it's a trade. So going back to that point I made before about everybody was bearish, bar none, at $80 per tonne iron ore price. And now we're starting to get people saying, oh, yeah, I know $100, we like it again. Well, you needed to like it at 80 and start being a little bit more cautious at 100 and start thinking about when do I start selling again? So iron ore will trade in cycles and it will follow the economic cycle, it'll follow the weather cycle, it'll follow what's happening in China at the moment, COVID and property. So, and the trading range of late has been $80. And that's where you start to get marginal producers get squeezed and you start to get cost support. And around about that 120 mark seems to be capping it on the high side. So we're kind of in the middle of that range at the moment. It feels like we may have a little bit more upside, but the 30% rally, that's done. If you weren't there, you've missed that.
On the screen in front of you there, it's just the consensus. These are not Rocky's numbers. These are consensus numbers from Refinitiv, looking at revenue over the 21, 22, and then estimations going out 23 and 24. I guess what the key takeout of that is that the market is bearish on iron ore prices. The market sees lower iron ore prices going forward, so therefore lower earnings for the iron ore companies.
That's right, they absolutely do. But James, if I put up any equity up there, we put a lithium equity up there now, they do exactly the same. Brokers aren't good at future forecasts, and we term the word here, brokers do begrudging upgrades. They only upgrade when they absolutely have to when the commodity prices move. But our job is to look ahead to try and forecast. So on that basis, iron ore prices going forward will be lower. Lithium prices will likely be higher, but nobody's prepared to put themselves out on a limb to do that. So but the trend in iron ore, given supply and demand thematics, suggests that prices on a trajectory to a lower number for longer.
It's whether or not they track down as low as where the market's at the moment. They could decline, but they could decline less
so
than
where
consensus is expected.
They're in a trading range of $80 to $120 iron ore price. When they're at Fortescue was $15 when it was $80 per tonne. It's now $20 per share, and it's the iron ore price is 100. So that was the trade. And from here, all things else equal, iron ore and Fortescue is probably looking like you've got to be thinking about, I've got to take profit soon.
So what's your assumption on iron ore price over the?
But this year the calendar year it's going to average about $100-ish per tonne, and next year there's going to be a strong rebound in the first half of next year if and when China gets out of their COVID issue and as they stimulate property or help property developers. And seasonally, the weakest year for supply of iron ore globally is the first quarter. So you'll have that stronger recovery out of China in the first 1 or 2 quarters of the year, weaker supply of iron ore, and you should get price maintaining that, again, 180 to 120 range and possibly in the higher end of that range. So we see iron ore next calendar average probably again close to about $100 per tonne. And longer term, we all anchored ourselves to a $50 to $60 number. It's probably more like a $70 number, 75, maybe even $80 number. So it's still on a trajectory lower, but it's not like a falling off a cliff type number, but it's certainly going to be lower longer. But the cash they're generating, if they're reinvesting it wisely, it's there's cash to give back.
All right, back onto some things. So the iron ore space and Fortescue's a trade. It's probably 50-50 at the moment, given where it's rallied from and to in a short amount of time. I'm just going to bring up IGO because this is the stock that we own. I know you cover it. We've owned this stock for a while. It's been a phenomenal performer for us. We have recently trimmed IGO in our flagship growth portfolio. We've recently sold out of Pilbara in our emerging companies portfolio. That's got more of a shorter term view around lithium there. IGO currently trading at $15.14. It's come back from around the $17 high. What's your take on IGO and the lithium stocks more broadly? I know IGO's obviously got nickel and other commodities as well, so that's a consideration as well. But the lithium space more broadly.
Well, IGO gives you both. It gives you future-facing commodities in lithium and also gives you nickel. So it's a bit of a hedge. And we see the same in RES where they've got iron ore and lithium. So there's different ways to play the lithium. You can play pure hard rock through Pilbara, pure brine, which is the salar process out of Argentina via Alchem. And you can play it via these two diversified plays in IGO and Minet, all with the backdrop that we've seen of late, which fantastic. And IGO specifically, I give them the award for this decade of the best M&A trader. I know I'm saying that it's only 2022, but their acquisition of the Chinese share of the Tianqi joint venture in Western Australia, it's just extraordinary. To have bought that at almost the exact low point in the lithium price cycle. Lithium price then was $400 US per tonne. That's a spodumene price.
Yep.
Spot price most recently printed by the Pilbara auction was about $8,000 per tonne. So they couldn't have done that deal smarter, better. So we talk about BHP have paid a fair or full value. These guys paid an absolutely extraordinarily, like probably decade best price for an asset.
So they sold their gold asset at the right price.
Sold their gold asset at the right price, bought their lithium at the right price, and they got a good nickel business, and they added Western Areas on at a good price as well. So smart management team, good operators, great balance sheet, like what they're doing, and they've got an enormous amount of expansion opportunity in their lithium asset in WA. It is the best quality, longest life, highest grade hard rock asset in the lithium space. So they're well placed. So I like that. But again, the equities will follow the commodity price. And in this case, it's what nickel does and what lithium does. And to my point before about where iron ore's headed in the short term, where coal's headed, and even copper, lithium feels like we're going to have a little bit of indigestion in calendar year 23. And again, I stress there's a long-term trend and there's a short-term cycle. Why? We've got economic activity being compressed by central banks globally. We've got COVID in China. And what that's meaning at the moment, we've got to consider what that means to Chinese demand, that COVID issue, and how that flows through into next year. There's also a rolling off of Chinese EV subsidies in calendar 23, which could be important to the marginal buyer. And just how EVs slow globally with this recessionary environment. So it may be that the ramp up of supply of lithium, which we know is too slow long term, but in the short term, it may just make a match to the demand slowing. And I note that one of the key consultants in this area is a company called Wood Mackenzie. We had them in our offices here about a month ago. And of the many things they talked about very bullishly, and they were bullish absolutely about the lithium space long term, they're calling for a, and I quote, lithium crash in calendar 23. Now, that's probably a little bit extreme, but
Goldman said the same thing a while ago.
Well, yeah. But they didn't have as much substance to their product. But I think that we need to be aware that copper could be a little bit softer. Now, that may be priced in now. Lithium could be a little bit softer as well. So these equities, they just had that chart on IGO, they will follow the lithium price of it. And going back to linking coal to this, when Whitehaven was $1 and I started to put out forecasts of $3 targets, $5 targets, $7, I always just using, if this is what the revenue delivered, this is where the equity should go. If I do the same on lithium stocks, if lithium price continues to print higher, they'll go higher. But you've got to look, what will the next auction be? What will the next price be? What will the next spot price be? It feels like the lithium market, if we do get slower EV take up in 23, we may have reached a plateau. So that means the equities at best will likely plateau, and we could see some weakness in the equities into the next year. But it's a chance to reload. Just think about this. In June this year, Pilbara was $2 per share.
It's
$2. And again, everybody hated lithium. It was all over. It's crashed again. That was the time to buy it. So Alchem was back at its low for the year as well. So be cognizant that I'm talking about an environment which could be softer in 23, but if you like the thematic long term, which we do, that's your opportunity. And buy these things at a discount to fair value, not a premium to fair value, which they're starting to come back now, that we're getting close to a buy.
You need to buy resource stocks when it's uncomfortable to do so, is my take out. And with
well-founded and well-structured logic behind it.
Absolutely. You can see on the screen there, this just looks at another feature on the Market Matters website. It looks at brokers' calls. So you sell, there's two strong sells, there's two sells, there's three holds, there's two buys, and there's three strong buys. So the market is very, very split on.
It's like in coal. You either like it or you don't. If you don't understand it, you don't like it. If you understand it, maybe you get it. So
yeah, but I look at Whitehaven Coal, and I think there's one analyst there that's got a sell on Whitehaven Coal. There's not a lot out there that's now negative on the space. It is undoubtedly a very crowded space.
Yeah.
When I read a lot of newsletters and a lot of clickbait out there, it's all about future-facing commodities, and I think that's a really dangerous position to follow the crowd in. As I said before, we often look at it. I encourage everyone out there to look at the Bank of America Merrill Lynch Investor Survey. that comes out. It shows where the market's positioned, and the market is, the market to me often moves in the direction of most pain. We've seen it in some of the ESG. ESG was a really overcrowded trade a month or so ago. That's pulled back. The US dollar was a very crowded trade. Cash was the biggest overweight that it has been in 20 years. 3 months ago, and the market tripped 13-14% on the back of that. So I encourage you to go out there and look at those things.
We'll take that down to resource equities. Look at the way 2 weeks ago there was a Chinese announcement that futures prices on the Wuhan exchange had fallen for lithium carbonate. The positioning in lithium equities is such that that's tiny bit of news.
Huge.
So equities fall 10 to 15% on a day. So that's telling me that market is long, that thematic is very long, and it's very susceptible to moves. Conversely, anything on the short side, gold, when there's a positive movement in gold, the market's so short gold equities rip as well. So be mindful of, I agree, that position is critical going forward.
We're going to wrap it up here at 12:45 p.m. We won't take questions today, but I'll take those questions on board, and we'll cover them in the Market Matters reports in the coming days and into our Q&A report on Saturday. I just want to thank Peter O'Connor sincerely for taking the time out, 45 minutes of your day, to give us a really short, sharp, concise view of resources. We do have a number of webinars planned over the coming weeks. So next week, we're going to look at some of the mid-cap growth opportunities. We've got Jonathan Higgins and James Bissonella coming on for a quick 45-minute rendition of what they like in their space that they cover, so tune in for that. And we've also got Cameron Duncan coming on the week after, looking at hybrid securities. So that's going to be an interesting one for all the income-focused investors out there. And then we'll wrap it up with our own Sean Hickman, who's our research lead, coming on and tying up how Market Matters is going to be positioning portfolios going into 2023 on the back of all these great updates and insights that we're getting across the board. So lots of content coming for Market Matters over the not too distant future. I'll just stop my screen off there. So plenty of updates coming for Market Matters over the coming weeks. So stay tuned. Thanks for joining us today. We'll see you now, but we'll be back in for another webinar next week. Thanks, guys.